Good afternoon or good morning, depending upon where you are joining from, ladies and gentlemen. Welcome to our webinar, What Comes Next in Hungary? Real-Time Reporting. So by way of introduction to our presentation today, on the 1st of July 2018, all VAT registered businesses must submit domestic business-to-business sales invoices with a VAT amount equal to or more than 100,000 Hungarian forints or 320 euros to Hungary's Tax and Customs Administration within 24 hours of issuing the invoice. This new requirement will impact IT, tax and compliance teams and processes, and you will need to be proactive to remain compliant. Today we will provide you with an overview of global tax reporting, a detailed view of the new Hungarian requirements and the business challenges they represent, and we will also be sharing some best practices we have acquired in supporting companies around the world in support of their reporting and compliance requirements. During the webinar, you will be able to enter questions into the question area of the webinar interface. At the end of the presentation, we will do our best to work through as many of these as time allows. So without further ado, I would like to introduce you to our presenters today, Andrew Decker and Casper Winkelmann. Andrew is our regulatory counsel at Sovos, focusing on indirect taxes, VAT, GST and sales tax across Europe and Asia. He is a member of the Massachusetts Bar with a JD from Northeastern University School of Law and a BA from Bates College. Casper is a solution principal for VAT at Sovos. He is responsible for behind the strategy at Sovos VAT, reporting global indirect tax software application and requirements. He also works closely with Sovos clients and partners to facilitate sales, software deployments and international compliance process transformations. Casper is a tax lawyer with over 20 years of international VAT experience. So Casper, without further ado, over to you.
Thank you for that introduction. So in the webinar, we would like to cover the following agenda. First, we want to start out to cover the tax compliance landscape, tax compliance and reporting landscape that is, to share a little bit what we experience in this landscape, what happened and what's coming next. Then we dive more into the technical details on what are the requirements and expectations for the new reporting requirements that is still having a go-live date of July 1, 2018. Then we will share our view and experience also with in our world how a solution should look like and what are the typical requirements to consider here. And then we would like to touch a little bit on why we think we are well positioned as a company for this new type of reporting requirements, and then we open up for questions and answers at the end. So to start with the tax landscape, we have seen that the tax landscape has been changed quite a lot by technology, and technology has really also changed governments on how basically governments today use more and more technology to implement all kind of complex mandates. And but we also see that those mandates are enforced in a way that requires a very rapid response versus a very slow response that we were used to in the past, where you had enough time to prepare for audits and prepare for documentation to present to auditors, whereas now you are considered and required almost to reply to tax authorities on audit-related issues via digital way in a very rapid way as well. Technology also has its impacts on how governments exchange the information. Governments today are sharing way more information together about taxpayers operating cross borders that give them way more information and view also on tax positions taken by companies in foreign jurisdictions as well. So in other words, a big change in the landscape. So when we look at the development of tax compliance and reporting and how that has been impacted by technology, we have here an overview that on the one hand shows the complexity of the process, and on the other hand shows transactional control level by tax authorities. And as you all know, is that in the recent past, I must say, where we still needed to complete actual paper forms and needed to submit them by post to tax authorities. That has been the status of compliance for a very long time, and that the first big shift happened when instead of sending it per post, you were required to submit your VAT return electronically to the tax authorities. That was quite a big game changer, and had a big impact on governments and then getting access, etc. However, if we now look on how this development is accelerating with the use of technology, you will see that only within a very short time frame of maybe a year and a half or 2 years, tax authorities moved some elements of from audit purposes also to the electronic way of submitting. And that is by first they introduced what they call an e-accounting audit file, what we know as a standard audit file for tax in most countries, meaning requirements for companies to submit very detailed transactional data in an electronic way in a certain format to tax authorities, enabling the tax authorities to use technology basically to already assess your tax position or perform an audit on your transactions. And that of course enables tax authorities in particular to already know a lot about your business in a very fast and efficient way. A step further in that development, and that we have seen recently in Europe as well, by Spain SII, where companies are required actually to not only on a periodical basis or on a request basis, as is the case with a SAFT return, but on a daily basis actually share the transactional information in what we call e-ledger reporting, real-time reporting of transactions. That has been a big change in the reporting landscape in Europe, although in other parts of the world that is already almost the standard already. And the next level we would say is that instead of not only sharing the transactional data, but one step further, that the tax authorities even ask you to pre-approve what we call pre-clearance. So in other words, you cannot send your invoices to your customers unless it is approved by the tax authorities. So that is even a further step of the use of technologies that the tax authorities use in order to assess your tax position, but be in control and also see what's going on at your end as well. So this is quite an accelerated development that we are still, I would say, in Europe in the standardized reporting part, and now some countries are moving to the e-ledger part, but in other parts of the world, the e-invoicing is almost already a standard. So when we say what comes next, when we focus on Europe, our expectation is that we indeed will move in this acceleration of tax compliance and reporting and going into steps until a real-time reporting situation is in play where tax authorities know immediately what your tax position is. So this type of reporting actually started in Latin America. In Latin America, well, like in many countries today, but the biggest percentage of the tax revenue was basically coming from VAT collections. And in the Latin America market a while back, a lot of that revenue got lost because of fraud and evasion. And tax authorities are very much focusing and then focus on all kind of regulatory changes, but also how can we avoid fraud and how can we avoid tax evasion. And the best answer today, what we have experienced in the Latin American market, is indeed the use of technology. So that's why you will see, particularly in the Latin American market, that technology is the most common method today for tax authorities to make sure they receive all information, they can collect the expected tax as much as possible and avoid fraud and evasion as much as possible as well. So there's a big increase in their VAT collections, a big increase in their cash flow, and it helped them also reduce and prevent tax evasion and black markets. And you can understand that when, going back one slide, when tax authorities in a certain region of the world come with such a success story, that immediately draws the attention of other tax authorities around the world. We are basically facing the same type of issues. How can we improve the tax collection, and how can we avoid fraud and prevent evasion? But if we just look at the success story in the Latin America space, is that for just Brazil only, there was an increase in tax collections and thus revenue of almost $58 billion, which is enormous, of course. When we look at Mexico, for example, is they improved their tax collections with 34%. So this is also a very success story for Mexico as well. And today, approximately 9% of the audits are happening electronically as well. Colombia as well, they already increased their tax collection with $8 billion, basically by reducing the tax evasion or tax fraud in their country by half. So in other words, quite a success story being shared all over the world. And the use of technology is not only a method to improve the tax collection, but is also a method to share data between governments across borders as well, and having access to way more information than they had, of course, in the past, when we were all in the phase of paper type of forms and returns. So if you see this development and then refocused to Europe, then when we, at least what is published in sense of the so-called VAT gap, then we know that in 2015 the VAT gap in the European Union was 151 billion euros. So that is enormous. And the funny thing is we as a company, when having provided a solution for actually since the beginning of this new type of reporting requirement in the Latin America space, and thus have gained a lot of experience on that technology requirement and how to help companies meet those requirements. We asked also the tax community in Europe, well, and the tax leaderships in international consultancy firms as well, where what do you think about Europe? Will they adapt the same model that is basically spread across the Latin American market? And this is a question we asked, and we did a survey, I think a year, well, not a year and a half, a little bit 2 years ago. And the answer we got from very experienced tax professionals was, no, this is not going to happen in Europe. No, and they gave multiple reasons for that. And then I think 4 months after that survey, Spain announced the real-time reporting requirement, basically copying the model of the Latin American market. So in other words, this development is going so fast, and that is understandable also from a government point of view, that if you see a very successful model, why don't you copy it and use it yourself to improve your collections? Now focusing on the EU, the 151 billion. If you look at the breakdown of that, breakdown per country, you will see basically that 4 countries that make out the biggest part of that gap. However, those are the vertical bars. However, if you follow the dots, that basically indicates what is the local country percentage gap, you will see that certain countries have, like Romania, the highest percentages of almost 40% collection gap. Slovakia 30, Greece about 28, Latvia also 26 approximately, Italy, etc. So if you look at this development that happened in the Latin America space and look at the gap and how governments are focusing to avoid tax fraud, you can imagine that the countries with the biggest gap and countries with the biggest percentage gap will probably very much look at the Latin American model and use that as a means to improve their cash flow and collections as well. So in our world, it is very likely that the ones that have the highest percentage gaps or the biggest amounts as well are very likely to move to similar type of models that happen in Latin America. So if we now focus on Europe and Latin America today and look at the countries where at which stage basically of the technology development of in tax compliance they are, you will see that the Latin American market is very much already at the highest level, almost applying an e-invoicing model, meaning a pre-clearance model in almost every country already. Whereas in Europe, we start a little bit behind in that acceleration curve, where I think in all countries in Europe, at least we have already e-filings. However, now more and more countries in Europe and in the EU are already implemented or start to implement an e-accounting reporting requirement, the standard order files for tax. And we know that Norway has announced that, Lithuania, but we already have that requirement in Portugal, in Poland, and Poland will add even a couple more. So in other words, more and more countries are entering into the e-accounting reporting requirements as well. And Spain already announced the e-ledger, or at least already has that live. Hungary has announced this, and Andrew will talk later about the requirements about Hungary as well. And I think Turkey already has a similar type of requirement as well. So in other words, Europe is behind when we compare it to Latin America, but you see already a development that kind of resembles the development that happened in Latin America as well. So our near future model, in our view, is looking like this. So yes, e-filing will be applicable in most of those countries, but a lot of them will move up the acceleration curve of technology requirements and moving from an e-filing to an e-accounting and to an e-ledger. So more and more ultimately will, in our view, will apply the Latin American model. So this as a background, and what we see as the development that's going on around the world when it comes down to requirements, we don't see Hungary as a standalone issue that introduced a new type of reporting requirements. No, we see Hungary as basically a country that follows the trend of compliance and is one of the first movers in Europe. And now I want to hand it over to Andrew, who will now focus and talk more about Hungarian reporting requirements going forward. Andrew?
Thank you, Casper.
Up to you.
Thank you. So before we just dive into what's changing, what's new in Hungary, just very briefly, what the current reporting landscape in Hungary, like most European countries, they have the standard periodic filings of Interstat, EC sales, VAT returns. They also have some compliance requirements specific to Hungary. They have the EKDR system for the tracking of goods. They have some online cash registers in certain industries, and they have very specific requirements about registering your invoicing software. So back in 2016, the legislature passed a new law which made two major compliance changes in the field of VAT. The first was a change of the requirements for what they have for their domestic summary report, and the second is the new invoice reporting mandate. So we're going to start with very briefly talking about domestic summary and then move to talk about the new mandate. So we can move on to the next. Yep. So the domestic summary report, as it stands now, It's a filing where you have to report all your domestic B2B sales and purchases over a certain threshold. So currently the threshold stands where if your the VAT on the sale or purchase was over 1 million Hungarian forints, which was about 3,800 US dollars or 3,200 euros. As part of the new law, that threshold is decreasing to 100,000 forints, which is a fairly substantial change in threshold. Just to get a sense of the numbers, that's a decrease in terms of actual sale price in US dollars. That would be like 13,000 US dollar sale versus a 1,300 US dollar sale. Additionally, what is required to be reported on the domestic report has actually shrunk on the sales side, because they're only going to require domestic sales that are in paper form to be reported on the summary report, because those sales are going to be subject to the invoice reporting mandate. Originally, this change was scheduled to take place this past July, but they delayed the implementation until next year. The domestic summary report, how you submit it is it's submitted with the VAT return in an XML format. I think the current version is 1760M. And if you fail to submit it, you're going to have possibly incur penalties of up to 1 million forints. So that's sort of just an overview of what's happening with the domestic summary report. And now we can move on to talk about the e-invoicing mandate. So the details of what's going on with this mandate is simply that whenever you have a domestic sale of over 100,000 forints, you have to submit that invoice in XML format to the tax authorities. Initially, there was some talk about, is this going to be a pre-clearance model? Is it going to be posted to Brazil? When they actually published their draft order, it appears it's going to be you have 24 hours to submit your return. If we actually move on to the next slide, we can see some of the details. So just like with the change to the domestic summary report, it's expected, this mandate is expected to go into effect on July 1st. You can currently test out they released a sample XML both in the draft order and on their test site, which is referred to as COBAC. You can test your XML files on that site. They've actually, I know they've released in the last month, they released a new version of that schema, which actually includes some English language descriptions in the schema. So it's a little more accessible for companies to start working with. We've been told that they're going to actually try to start doing some data validation testing coming in January. We'll see if that comes to be fairly soon. And there's expected to be penalties of about 500,000 forints per invoice, possibly, if you don't submit your invoices on time. So if we go to the next slide, we can start to see some of the challenges associated with this mandate. So the biggest lift with this mandate is actually probably going to be on the IT side, because you're going to have to make sure that your invoice software and your ERP systems are set up to export the data on your invoices in the prescribed XML format. Additionally, you have to make sure you have the connection with the Hungarian tax authorities, and you have to be able to submit these invoices within 24 hours. There is provisions in the law, as it stands right now, stating that if you have a malfunction, your internet goes out, that you have 24 hours from when that malfunction is fixed to submit the invoices to the government. And currently, in order to use the test site, you also have to have a fixed IP address. I know the authorities have stated that their goal is to get rid of that requirement, but for now, you still have to go from the one IP address. This also creates challenges for businesses in terms of their audit procedures. Now the government's going to know in real time essentially every single sale you make over a certain amount, which means if there's any errors on your VAT returns, any discrepancies on your domestic summary reports, the government's going to know. And so you're going to have to be really careful when filling out all your other reports because the government now has all this data. I think if we go to the next slide. Yeah, so the biggest thing, it's a new report. You need to be ready to handle this data and get it to the government. And again, once again, if you aren't prepared, you're going to be hit with pretty nasty fines. That's sort of an overview of what's going on in Hungary and some of the requirements. At the end of the presentation, if you have more detailed questions, we'll be happy to answer. But now I'm going to hand it back to Casper.
Okay, thank you for that, Andrew. So let's now focus more on the solution requirements. Remember, we have helped companies in Latin America for actually the last 10 years already. We have focused and implemented also the solution for Spain. So we have some experience what the solution requirement should look like, and would like to share that with you. So in this overview, you see on the left side the government regulation. The government regulation using technology that becomes way more aggressive. I mean, 24 hours to report is quite different than having a whole month to report. So it's evolving quite rapidly also, as we just discussed, and becomes borderless. And in order for you as taxpayers, with probably international focus as well, to respond to that new requirement, and not only for Hungary, but actually for other jurisdictions that will follow or already followed, the solution requirement, in our view, needs to meet at least 6 main criteria. First of all, is for this requirement to be met, you need to have a good visibility and control of what you report to the tax authorities. If any invoices get stuck or for some reason it does not get reported, whereas in your return you will include it, there will be a big difference to be explained, and ultimately that will end up potentially in penalties immediately. So in other words, it's very important to make sure you monitor and have control over that process. The second element is that the solution must be adaptable and flexible, more or less. And what we mean by that is that tax authorities require a very detailed level of data. There are always some challenges for companies to get to that detailed level in order to share that with tax authorities as well. And also there needs to be, together with the transactional data, also some qualification elements to be sent with them to the tax authorities as well. And in order to facilitate that type of need and requirement, it is important that whatever solution you select, it needs to be adaptable and easily adjustable in order to meet and be flexible about this new type of reporting requirement, and without having to go through a whole new implementation project again. The other thing is, of course, that the data that you share must be very accurate, because the tax authorities are reviewing that and are reusing that information also to assess your tax position. So you cannot, in the current way of working, where we typically focus on running reports, reviewing the reports, analyzing reports, and then submit. That is all possible, and you have the luxury of time on your hand to do that, although within the given deadlines. In a real-time reporting requirement, that is not possible anymore. You need to have a real-time, accurate set of data. In other words, you need to have a solution that can help you facilitate that need and be able to actually real-time maybe analyze and correct data as well. The other and one of the most important elements, I would say as well, is that Hungary is not a standalone new type of reporting requirement, the Hungarian reporting requirements. A lot of you probably are already involved with Spain, but maybe in other markets as well. And so we see this as the trend. So if you consider a solution, we advise to consider a solution which is scalable and reusable, not only in Hungary, but also in other jurisdictions that will most likely follow. So when you take a decision maybe today for Hungary, I think you should consider the strategic thought and the trend here as well, that you acquire a capability that helps you roll this out to other jurisdictions instead of going to a country-by-country focus. Well, the fifth element, of course, is it must be compliant. And what is challenging here in particular are the changes in law. If you have a real-time reporting requirement, you must have a solution that is maintained, that is updated real-time as well, because any changes in the law, you need to comply then immediately with your reporting requirement. And that is a big challenge if you don't have the structure organization to back that up in your solution. And of course, sharing data requires a very secure environment that is stable and reliable as well, to ensure that it does not break down. And then the data, which is quite sensitive because it contains information about your customers, about your suppliers, etc., must be shared in a reliable environment as well. So those 6 elements we think are very important for this type of reporting and development. And from a company perspective, as an objective, you can say, well, we can either try to build something ourselves, or you can acquire this capability and have more or less peace of mind and focus on other important stuff within your company as well. And by acquiring the company, you will, by acquiring a solution that meets these 6 requirements, you have the possibility to basically decrease your processing costs because it is an all automated process, and focusing on not only an automated process but also on an accurate process that not only reduces your cost but also mitigates your risks, and ultimately excuse me, simplifies your operation. So if we focus more on the scalability and globalness of a solution, what is important is that the real-time reporting requirement is basically what we consider a pre-filing of fiscal reports. The data that you share to the tax authorities are basically expected to end up ultimately in the monthly or quarterly or bi-monthly return that you still need to submit to the tax authorities. In other words, the tax position that you take in your VAT return must be reconciled with the data that you already shared real time on the transactional level with tax authorities. So for us, it really makes sense that when focusing on meeting these new requirements, you're not focusing on just how can I transmit transactional data from using technology to the tax authorities, but also think about, okay, that type of reporting is actually the same data that you use for your VAT return process. So in talking to a lot of companies for meeting these type of requirements, also for Spain and other countries, we noticed that a lot of companies were focusing just on the real-time reporting requirements solution and said, well, yeah, we have a separate VAT return process. And then when I asked the question, well, but then you need a third process because you need to reconcile the two. So doesn't it make sense to use one scalable platform that enables you to report both using the same set of data and thus report on the same data as well, as is received by the tax authorities and as is expected by the tax authorities as well? Because what you should consider here is that the tax authorities with this new type of reporting requirements have what we call a triangulation data comparison possibility. They can not only compare the data that you already shared real time with the data that you summarize in your VAT return, but basically they also compare the data that you share about your customers and about your suppliers with the actual suppliers and customers as well. So in other words, the tax authorities are receiving a very important set of data that they can use for all kind of reporting and analysis and other purposes. And you should be aware that this is not just making sure you meet deadlines and you have a technology in place that just submits and helps you submit within that deadline. No, but focus on also the potentials of audits and mismatches between your data and your VAT return, your data and the data of your supplier, and your data and the data of your customer. What we have experienced from Spain today is that Spain only provided a very short window of time for companies to comply with. So that created a big challenge for companies. As a result, a lot of companies have selected for just a real-time reporting solution. So let's get a quick fix done and we at least meet the deadline. What happened now in practice is that almost 9 out of 10 taxpayers have a mismatch of the data they have reported real-time and the position, the summarized data that they included in their VAT return. So for us, that does not make sense. It is the same set of data. You should apply that in the same, via the same platform and reuse that. But just as food for thought here is that our advice here is that don't focus only on the real-time reporting solution. Look at the bigger picture as well. So in other words, is the best strategy for your company a point solution or a scalable solution? And it may be that you are only in a few countries or maybe even only in Hungary. Then maybe, of course, a point solution makes sense. But if you are having an international footprint, doing operations in a lot of countries in Europe or outside Europe, then it may be worthwhile considering a scalable solution. And if we just look at the differences between the two, is that with a point solution, you basically have, in our view, a more restricted visibility, namely only on the transactions that you share via that solution. Whereas with a scalable solution, you see what's going on, not only in your real-time reporting, but also in your VAT filing. And you can compare the two, and not only in Hungary, but also in other countries as well. With the scalable solution, you will also have a more micro focus, meaning you deploy locally in design to support a single solution, whereas in a scalable solution, you're deployed to support a global approach, which is more standardized and easier to operate. Also, with a point solution, you just react to the local requirements. Whereas with a scalable solution, you're not only just focusing on meeting the requirement in that country, but also focusing on being ready for new mandates that will very likely be announced in other countries after Hungary as well. Point solution is also something you can to consider with is point solution is a full-time 100% implementation project. A scalable solution is it's a one-time setup, but once you're set up, you can roll it out to other jurisdictions, and then rolling out to other jurisdictions still means that you need to make some adjustment, but you don't enter into a full-blown implementation anymore because you already have a basic setup ready. Also with point solutions if a new mandate is announced, you immediately need to run in a full-blown implementation project, and thus the cost that is associated with that. With a scalable solution, you already know your subscription base, you know what you're paying, and there will be maybe a small increase to that, but you have a way more predictable cost and expectation here. Point solutions are also more difficult to manage from an audit perspective because it requires more effort to provide the right audit defense. Whereas with a scalable solution, which is more standardized and where you have more information available how you do that, is then easier to facilitate for audits. Also, with point solution is if you select for a point solution in Hungary and go for another point solution in another country, then you have a multiple solution set that you not only need to maintain, but you also need to update with new changes and rules and rates and change to the requirements as well, which is a very high maintenance type of dealings, very difficult to manage. Whereas with a scalable solution, you have one solution to manage, and that solution by itself will already be automatically updated with the changes that are happening with the existing mandates and new mandates as well. So that in mind, I'd like to share a little bit on how Sophos looks at this new development and how we have tackled this type of reporting requirement and this kind of scalability that I just shared. And basically we say, well, what is very important and the heart of our organization is we need to have a very strong regulatory analysis team. Andrew is part of that team, and he just shared part of his knowledge for relating to Hungary. But for us, this is the heart of our organization. And without it, we cannot really build further, because this information is directly fed via, of course, product groups into our platform. One platform, so not multiple platforms, but one platform. And from this platform, you have all kind of functionality in place to do the processing, but also to ultimately submit all the required reports, so that not only the traditional reports like the VAT returns and the listings, but also the real-time data and the soft T data. In other words, via the same platform, you report the same data, only in different formats to tax authorities, and therefore have one overview, one visibility, where you can see what's going on, where you can do the processing and make sure you are compliant. We work with trusted partners, partners who help us out sometimes on the nitty-gritty of the local requirements, but also help out with implementations if customers would like that. And we do this with a global focus. So we are very strong in the Latin American market and have gained, in particular on the real-time reporting, a lot of experience. But in EMEA, we have that similar experience, and we are rolling out to more countries in APAC as well. North America is more at the sales and use tax, as you know, less in VAT, but that's something that we focus on as well as a company. So from a solution point of view, how do we translate that into technology? So on the left side, we basically say, well, we have cut that in three elements. First, we must make sure that the data that the tax authorities ultimately require, and that resides in your ERP system or legacy systems or multiple ERP systems in combination of, we need to extract and receive that information in our cloud-based solution. So we offer companies with all kind of options to extract and receive data from the ERP system to our cloud-based solution. In our cloud-based solution, we have three layers of functionality. Functionality that helps you manage your compliance process. That includes a workflow, that includes a deadline tracker, a filing calendar, that includes dashboards and overviews of trend analysis and all kind of views that you can get out of the data set that it is sent to the cloud-based. We have functionality that helps you execute the process. So functionality, logic rules to enhance the data, full-blown data analytic possibility, but also reconciliation possibilities. And report generation functionality that ultimately helps you to generate all type of forms that need to be sent to tax authorities. So the real-time reporting, the SOFT, the VAT returns, the Intrastat, the listings, and the VAT books, and the country-specific forms as well. Then to make sure that any changes or any audit trails that need to be shared with tax authorities as well, we have also an audit trail. The audit trail is not only about making sure we capture all the changes that were made to the original data or corrections to resulting from data analytics. But it also includes automatic content updates. So any changes to the reporting settings will be first tracked by our regulatory analysis team that will be translated into new functionality or updates on existing functionality and reports in our solution and made available directly to our customers. And in this way, we can create this full-blown and integrated reporting requirement that we, basically from your ERP system, create an integration option to send to the cloud with functionality sent to the tax authorities and actually receive information back from the tax authorities and push that back into your ERP system as well if that is one of the requirements as well. And in this way, we make sure that we not only tackle the submission requirements, making sure you meet your deadlines, but also make sure that your data is more accurate and also make sure that your data is up to date with the latest changes in mandates and requirements as well. From here, I want to pause and open up for questions.
Thank you very much indeed, Casper and Andrew. We are running a little bit short on time here, so I think we've got time just for one question. So, Casper, one of the questions that's come in here is how similar or different is the Hungary mandate from that in Spain and Brazil?
Yeah, I think Brazil was one of the first countries that implemented this type of reporting requirement, and they are in what we call a so-called pre-clearance model, meaning that every invoice needs to be approved by the tax authorities first before it can be issued. And that has a big impact, not only on just tax reporting, but also on the whole operational side of the business, because without a valid invoice that needs to be associated also with the truck that moves the goods to the customer, you cannot actually distribute your products to your customers. So in other words, if you don't get this right, your operational side is delayed or gets stuck as well. So that has a big impact on business, and that's why there's a big focus in Brazil to make sure everyone meets this requirement. Spain is more the first level, I would say, of this model, where there is no need for a pre-clearance as yet. You can do business as usual, only a couple days after the fact you need to share that data and the tax authorities assess whether that is correct or not. And if it's wrong, you need to make your corrections still within a couple of days, but still you have some time and you don't need to stop your business. Hungary is more or less in between, I would say. Like Andrew just said, a pre-clearance model was originally announced, but they moved away from that a little bit, in that sense that you can still issue the invoice without the approval, but you need to get the approval still, and you need to submit within 24 hours. So that's still pretty fast. It puts a lot of pressure on companies to meet this requirement.
Thank you very much indeed, Casper. Well, look, ladies and gentlemen, there's been a lot of very interesting questions asked via the webinar interface, and we will endeavour to get back to you personally with answers to the questions that have been asked. One of the Sovos team will within the next day or so. What I'd like now to do is just wrap up. If you could move to the next slide, please, Casper, that'd be super. So, just like to conclude with a little bit more information about the support and help Sovos can provide. We actually have a wealth of information which can be accessed in the resources section of our website, sovos.com. You can also subscribe via our website to our newsletter and regulatory feed, and we regularly publish the latest information and regulatory changes, opinion and guidance on our blog, which again can be accessed via our website. For the social users amongst us, you can also follow us on LinkedIn and Twitter. And if you would like to contact us directly with any specific questions, you can email us or contact your local office. Finally, we would like to thank you for attending this webinar and do hope you have found the content both stimulating and informative. And please do remember, if you have any further specific questions, please do contact us and we will do our best to help. So many thanks and good afternoon.